This is the story of a regulatory framework that has millions of Americans worried their bank deposits could be converted into worthless stock during the next financial crisis. And while the truth is more complex than the headlines suggest, what happened in Cyprus in 2013 and what nearly happened to American banks in 2023 reveals why this fear isn't baseless. There is no FDIC confiscation plan waiting to seize your savings, but there is a real regulatory mechanism created after the 2008 financial crisis that changed how failing banks get resolved, and depending on how much money you have in the bank, you need to understand exactly where you stand. December 10, 2012 is when the FDIC and the Bank of England jointly published a paper titled Resolving Globally Active, Systemically Important Financial Institutions, and most people have never heard of this document. Buried in its technical language is a strategy called single point of entry, and this strategy has critics warning about deposit confiscation. Single point of entry works like this. When a massive bank holding company fails, regulators don't shut down the entire operation, but instead place only the top-tier holding company into receivership. The operating banks underneath, where your deposits actually sit, stay open and functioning while the losses get absorbed in a specific order, with shareholders wiped out first, then subordinated debt holders, then senior bondholders. The paper explicitly states that insured depositors themselves would remain unaffected, which means if you have less than $250,000 in a single bank account, FDIC insurance protects you completely. Not a single depositor has lost a penny of insured funds since the FDIC was founded in 1933, and that's a record that still holds today. But notice that very careful language about insured depositors, which raises the question of what happens to everyone else. Total domestic deposits in FDIC insured institutions amount to approximately $20 trillion, and of that massive sum, roughly 39% sits in accounts classified as uninsured because they exceed the $250,000 limit. We're talking about somewhere between $8 and $9 trillion in vulnerable deposits. The Federal Reserve addressed this vulnerability by creating total loss-absorbing capacity requirements, finalized in January 2017 and taking effect in January 2019. And these rules force the 8 largest US banks to maintain at least 18% of their risk-weighted assets in equity and long-term debt at the holding company level. JP Morgan Chase, Citigroup, Bank of America, Goldman Sachs, Morgan Stanley, Bank of New York Mellon, State Street, and Wells Fargo make up these 8 institutions, and together they hold combined assets exceeding $11.5 trillion. The whole point of these requirements is to create a buffer of bail-enabled debt that can absorb losses, before anyone even thinks about touching depositors, which sounds good in theory. Theory and practice turned out to be 2 very different things, and that's where the real story begins. March 2013 is when the small Mediterranean island of Cyprus became the testing ground for bail-in policies, and what happened there sent shockwaves through the global financial system that regulators are still studying today. Cyprus had a banking sector that had grown to approximately 700% of the country's GDP, which meant when 2 major banks collapsed, there simply wasn't enough government money for a traditional bailout. Regulators tried something different, and the results were devastating for depositors. Laiki Bank, also called Cyprus Popular Bank, saw regulators confiscate 100% of all deposits above €100,000 before the bank was completely wound down. Bank of Cyprus converted 47.5% of deposits exceeding €100,000 into equity, into stock in a failing bank, and approximately 20,000 depositors watched €3.8 billion in deposits become shares overnight. What made it terrifying was that initially the government proposed taking a percentage of even insured deposits below the insurance threshold, and while the Cypriot parliament rejected that plan, the mere proposal showed how desperate things had gotten. Capital controls limited daily withdrawals to €300 for months afterward, and people who had their life savings in those banks watched helplessly as their cash became equity in institutions that had already failed. American regulators watched Cyprus closely, and that's when they started taking notes. Silicon Valley Bank collapsed on March 10, 2023 with $209 billion in assets, and 2 days later, Signature Bank failed with $110 billion, while First Republic Bank went down on May 1st with $229 billion in assets. 3 of the 4 largest bank failures in American history happened within 8 weeks, and the system faced a test it wasn't ready for. 88% of Silicon Valley Bank's deposits were uninsured, which meant these weren't ordinary people with savings accounts, but technology companies, venture capital firms, and wealthy individuals with millions of dollars each sitting well above the FDIC insurance limit. According to the new bail-in rules, those uninsured depositors should have taken losses, but that's not what happened. Treasury Secretary Janet Yellen, the FDIC board, and the Federal Reserve Board invoked something called the systemic risk exception, which required approval from 2/3 of the FDIC board, 2/3 of the Federal Reserve Board, and the Treasury Secretary after consulting President Biden. The decision came down to protect all depositors, even the uninsured amounts, and shareholders were wiped out entirely across all three banks. $43 billion in shareholder value vanished while bondholders took massive hits, and in total, investors lost an estimated $55 billion in what amounted to a partial bail-in that just didn't touch depositors. The FDIC and Treasury made one thing very explicit though, and their words were that this was an exception, not a new policy. Yale School of Management analyzed those 2023 bank failures and found something troubling about why the bail-in framework couldn't work the way it was designed. These banks didn't have enough long-term debt to execute a clean bail-in, which meant the whole regulatory structure built after 2008 couldn't function when it was actually needed. Long-term debt at Silicon Valley Bank equaled only 3% of its risk-weighted assets when it needed $1.7 billion more, and Signature Bank had a total loss-absorbing capacity ratio of just 7.1%, falling short by $5.8 billion. $779 million in senior notes was all First Republic had when it needed $6.1 billion more to meet the standards. $13.6 billion is what the FDIC estimates it could have saved if these banks had met European-style standards requiring 13.5% of risk-weighted assets in bail-in-able debt. The proposed fix came in August 2023 when the FDIC announced new long-term debt requirements for banks with assets exceeding $100 billion, but as of January 2026, those rules remain unfinalized. November 2022 is when something else happened that made people nervous, and that's when the FDIC held a Systemic Resolution Advisory Committee meeting where Gary Cohn, the former Goldman Sachs executive and Trump administration economic advisor, reportedly made a comment that went viral among financial observers. His words were, "I almost think you'd scare the public if you put this out," and the question everyone asked was, what exactly? He was referring to FDIC insurance protects you completely if you have less than $250,000 in any single bank account, and that protection is backed by the Deposit Insurance Fund, which stood at $150.1 billion as of September 2025, and ultimately by the full faith and credit of the United States government. You can multiply that coverage through different ownership structures, including individual accounts, joint accounts, trust accounts, and retirement accounts, with each category getting separate $250,000 protection at each institution. Anything above that limit puts you in a different category, but even then, you're not completely exposed. Depositor preference rules mean that even uninsured deposits get paid before general creditors when a bank fails, which puts you ahead of bondholders in the priority line. Single point of entry was specifically designed to protect bank subsidiary depositors by absorbing losses at the holding company level first, and for the 8 largest banks with total loss-absorbing capacity requirements, there's a massive buffer of equity and long-term debt that has to be exhausted before anyone touches deposits. Former FDIC Vice Chairman Thomas Honig acknowledged in his 2013 statement that if losses exhaust the holding company's resources, then creditors of subsidiaries, potentially including uninsured depositors, would be subject to loss, and that's the worst-case scenario nobody wants to talk about. The debate isn't really about whether the government plans to confiscate ordinary bank deposits because the evidence shows they don't, and the FDIC insurance limit remains solid while the regulatory architecture specifically protects depositors by design. What happens when the next crisis hits banks that don't have enough bail-enabled debt is the real question, along with what happens when protecting all depositors costs more than the systemic risk exception can cover, and what happens if that crisis occurs at multiple institutions simultaneously. $55 billion is what the 2023 bank failures cost the FDIC precisely because those banks weren't structured for bail-in, and regulators chose to protect uninsured depositors anyway, while explicitly saying this was an exception. Next time the question is whether they'll make the same choice or whether Cyprus 2013 becomes the template instead of Silicon Valley Bank 2023, and nobody really knows the answer. The framework exists and the legal authority is in place, but whether it gets used the way regulators intended by absorbing losses at the holding company level, or the way depositors fear by converting their cash into worthless equity, depends entirely on whether banks actually maintain those buffers and whether regulators have the political will to let uninsured depositors take losses when a crisis comes. Your deposits aren't being confiscated, but the rules of the game changed after 2012, and if you have more than $250,000 in any single institution, you're playing by different rules than you were before. That's not a conspiracy theory, but just the regulatory reality of post-2008 banking, and understanding where you stand matters more now than it ever has.